For more stock news updates, remember to press the like button and subscribe. With that being said, let's get straight into the video. These detailed evaluations were carefully selected from a broader set of approximately 70 reports released by the research team today. Among the highlighted companies are three influential names across their respective sectors: Walmart, Palantir Technologies, and Uber Technologies. Each of these businesses represents a distinct area of the economy: retail, artificial intelligence, and mobility services. And today's insights explore their latest developments, strategic strengths, challenges, and future outlooks. Let's begin with Walmart. Over the past 12 months, Walmart has delivered exceptional stock performance, comfortably surpassing the broader retail supermarket sector. The company's shares rose by over 55%, while the overall industry recorded a gain of nearly 53%. Much of Walmart's success can be traced back to its deeply diversified business model, which enables it to effectively adapt across economic conditions and market dynamics. A core element of Walmart's competitive edge is its highly integrated omni-channel strategy. By seamlessly connecting in-store and digital shopping experiences, Walmart has effectively drawn increased consumer traffic to both its physical retail outlets and online platforms. This cohesive model not only caters to shifting consumer behaviors, but also reinforces customer loyalty across different shopping channels. In addition to these efforts, Walmart has placed considerable emphasis on enhancing its delivery infrastructure. These improvements have allowed the company to capture more market share within the grocery segment, a critical area of recurring consumer demand. The emphasis on convenience and faster delivery windows has paid off, contributing positively to customer satisfaction and retention. Furthermore, Walmart is not just relying on traditional retail to drive growth. It has ventured into emerging areas such as advertising services and subscription-based membership programs. These relatively newer business verticals have begun to show meaningful contributions to the company's top and bottom lines. During the first quarter of fiscal year 2026, Walmart reported year-over-year growth in both earnings and revenues, indicating robust operational momentum. Despite this strong start to the year, Walmart has expressed some caution regarding upcoming quarters. The company decided against issuing forward guidance for the second quarter, citing uncertainty surrounding global trade tariffs and a macroeconomic landscape that remains highly fluid. Even though recent reductions in tariffs may offer some temporary relief, these costs are still expected to influence retail pricing by driving it upward in the short term. As a result, the company anticipates potential pressure on consumer demand and margins. Now moving on to Palantir Technologies, a company operating at the intersection of data analytics and artificial intelligence. Since the beginning of the current year, Palantir's stock has delivered extraordinary returns, climbing by over 82%. This far outpaces the performance of the broader internet software sector, which recorded a more modest gain of slightly above 7% during the same timeframe. This stark contrast highlights the growing investor confidence in Palantir's long-term strategy and its ability to scale within a highly competitive market. Palantir's value proposition centers around its sophisticated, artificial intelligence-driven platforms. These platforms are purpose-built to deliver real-time insights and operational efficiencies across both government agencies and commercial enterprises. Foundry enables businesses to optimize decision-making through data integration, Gotham provides governments with actionable intelligence, and the artificial intelligence platform serves as a next-generation tool to accelerate enterprise adoption of artificial intelligence technologies. One of the most notable developments for Palantir is its involvement in large-scale defense and government-related initiatives. At the same time, Palantir is conducting artificial intelligence boot camps for commercial clients, a move that not only showcases the company's training capabilities, but also helps in onboarding and retaining a broader client base. These boot camps have proven instrumental in accelerating client readiness for enterprise-level artificial intelligence deployment. From a financial perspective, Palantir maintains an exceptionally strong balance sheet. With over $5.2 billion in cash reserves and no outstanding debt, the company possesses ample liquidity to pursue further innovation and strategic acquisitions if needed. Its recent addition to the Standard & Poor's 500 index has further amplified visibility among institutional investors, potentially boosting long-term demand for the stock. Despite these advantages, Palantir has chosen not to distribute dividends, a decision that may concern some income-focused investors. However, this move is often viewed as a positive sign by long-term growth investors, as it suggests that the company is prioritizing reinvestment into high-return opportunities rather than cash distribution. That being said, Palantir is not without its challenges. The company operates in a fiercely competitive artificial intelligence environment with large technology firms vying for dominance. Rising development and deployment costs add to the complexity of maintaining profitability at scale. Additionally, Palantir's elevated valuation, stemming from its significant run-up in stock price, an increase of nearly 500% over the past 12 months, raises questions about sustainability. This substantial growth has prompted a neutral rating from analysts who suggest that the stock may be due for a price correction or period of consolidation in the near future. Let's now turn our focus to Uber Technologies, a dominant player in the North American ride-hailing industry. Over the last 12 months, Uber shares have appreciated by over 48%, significantly outperforming the broader internet services sector, which experienced a decline of approximately 2.3% during the same timeframe. This discrepancy highlights the strength of Uber's business model and its ability to navigate macroeconomic challenges. While ride-hailing remains Uber's core operation, the company has strategically diversified into adjacent markets such as food delivery through Uber Eats and freight logistics via Uber Freight. These business extensions serve as vital growth engines, enabling Uber to smooth out cyclical fluctuations in ride demand and tap into broader market opportunities. This multi-pronged strategy enhances revenue stability and reduces reliance on a single source of income. Looking ahead, Uber is expected to focus more aggressively on expanding into suburban and semi-urban markets, regions that are typically underserved but represent a growing demand base. This geographic expansion is likely to drive incremental growth and improve operational efficiencies across its network. Analysts remain optimistic about Uber's capacity to handle competitive pressures and economic shifts, citing its proven ability to pivot business models and its data-driven approach to decision-making. However, some risks still linger. There is mounting concern over a potential slowdown in gross bookings, which may be influenced by factors such as economic uncertainty, shifting consumer preferences, or increased competition. Additionally, discussions around eliminating intermediary service layers could impact Uber's revenue collection mechanisms and long-term margins. Financially, Uber carries a debt load that exceeds the industry average, which could limit flexibility in terms of capital allocation and investment. Furthermore, currency fluctuations in international markets add another layer of risk to revenue predictability and profit margins. Taking all of these variables into account, analysts maintain a cautious but balanced stance on Uber's stock. While the recommendation is to hold for existing investors, prospective buyers are advised to wait for a more favorable valuation or market entry point before initiating new positions. In a summary, Walmart, Palantir Technologies, and Uber Technologies have each demonstrated notable performance and strategic growth in their respective sectors. Walmart's diversified business model, strong omnichannel approach, and investments in delivery and advertising have led to year-over-year growth in earnings, revenues, and e-commerce, although the company remains cautious due to tariff uncertainties and economic volatility. Palantir Technologies has surged over 82% year-to-date, driven by its artificial intelligence platforms like Foundry, Gotham, and artificial intelligence platform, strong financial position with over $5.2 billion in cash and no debt, and growing visibility following its inclusion in the Standard & Poor's 500 index, though concerns remain about rising costs and elevated valuation. Uber Technologies, meanwhile, outperformed its sector with a 48% stock gain, leveraging its dominance in ride-sharing and strategic expansion into food delivery and freight. But challenges such as slowing gross bookings, high debt levels, and currency fluctuations have led analysts to suggest a wait-and-see approach for new investors. For more stock news updates, remember to press the like button and subscribe. With that being said, I will see you in the next video.